Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, October 21st, and we'll see how things look for Wednesday, October 22nd. It was a pretty quiet day in the markets, but subtle shifts in key indicators are setting the stage for what's next. Going over Tuesday's market performance, the S&P 500 closed virtually unchanged. The Dow, however, set a new all-time high, being buoyed by well-received earnings reports. Meanwhile, the Nasdaq and Nasdaq 100 had slight declines. Small and mid caps were mixed, but had a pretty solid day overall. Price action was subdued. The S&P opened flat, dipped to the daily pivot at 67.23, found support, and rallied to test resistance at the 67.50 level. Despite a couple of attempts, the S&P couldn't break through and traded sideways between 67.50 and the unchanged level for the rest of the session. Volume was slightly above average. Looking at the technicals, a key highlight was the parabolic SAR flipping from negative to positive. Both the Williams %R and stochastics in the short term are continuing to show positive short-term momentum. However, the average directional index, or ADX, is moving lower, hinting at a potential shift to a trendless environment. The VIX continues to decline, and after last Friday, that's being called a volatility implosion. Historically, such drops as seen last Friday have been bullish going forward. The S&P 500 remains positive across all three timeframes, but continues to be more than 10% above its 200-day simple moving average, a sign of potential overextension. Beyond the technicals, macroeconomic factors are influencing sentiment. Interest rates continue to decline with the 10-year yield settling at 3.96%. This appears to be driven by market dynamics rather than a continued flight to safety. Meanwhile, the US dollar strengthened and gold declined. Some analysts are thinking gold might be entering a consolidation phase after its recent run. The government shutdown continues, which is limiting economic data, leaving the markets to focus on earnings and geopolitical developments. Speaking of earnings, we're in the thick of the season, and positive reports have helped maintain a constructive tone, particularly for the Dow. However, sentiment remains negative, ticking down to 29 from 30, though it's improved from last week's low of 23. Sector performance offered some clues about market dynamics. On Tuesday, value stocks outperformed growth, but the discretionary to staples ratio is improving. Utilities and staples, however, lagged, and tech megacaps underperformed relative to the broader market. Semiconductors softened a bit, but home builders, transports, retail, and regional banks are trying to show signs of recovery. One area of continued concern is valuations. The S&P 500's PE ratio stands at 23, and the Nasdaq 100's is at 29, both signaling an expensive market. Defensive posturing continues to increase, but commodity trading advisors remain heavily weighted in equities, suggesting confidence in stocks. Looking ahead to Wednesday, October 22nd, the outlook remains cautiously optimistic. The S&P is positive across all time frames and is trying to build positive short-term momentum. However, resistance at 67.50 will be a level to watch. A breakout above this level could signal further upside. On the economic front, data remains sparse. The MBA Mortgage Applications Index is scheduled, but it's unlikely to move the market significantly. Investors will also keep an eye on U.S.-China trade developments, as any escalation could shift sentiment. Seasonally, October 22nd has been weak historically, and the week after options expiration tends to lean bearish, so caution is warranted. Other areas to keep an eye on: there's still an unconfirmed Hindenburg omen, which has until November 7th to trigger, and the Zwag NYSE breadth thrust, which needs a strong upward move by October 24th to generate a bullish signal. Earnings reports, particularly from high-profile names such as Netflix, will also influence market direction. In conclusion, the S&P seems to be holding up well with positive trends and improving technicals, but it's not without risks. Longer-term overbought conditions, continued high valuations, and choppy price action suggest a lack of strong conviction. It's best to stay vigilant, keep an eye on the pivot points and macroeconomic catalysts. Thank you very much, and I will talk to you in the next podcast.